What do you think was the worst market environment? 2020, COVID, or 2025 with AI? Well, that's not a trick question because actually investors seem to be more frightened about the market in 2025 than they were 5 years ago when the market just absolutely tanked, largely because of global government intervention. My name's Don Creech.
Yeah. And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So how do we measure fear? Well, we measure fear partly by market participation, and that's kind of the corollary or the inverse of how much cash people are holding in their portfolios. And the portfolio cash allocation today is higher than in 2020. And I want to say, does that make any sense? How do you explain that? My goodness, we had a market that crashed 20% and then did recover, but then we spent another year unwinding the recovery.
Sure.
And here we are now with a year that was doing okay. April tariffs along the way kind of messed with our thinking and our models and tested whether or not we were serious about being in the market. And now we're on a continuous run of new highs. In fact, I've lost the track of the number of new highs we have in the S&P 500.
Right.
The last count I had was 14, and we've had several more since then. But despite that, cash allocations in portfolios is 30% higher than 5 years ago.
Well, and Don, one of the problems is that string of new highs. There's a lot of investors that get scared off by that. They go, oh, these markets are too high. This can't keep going on this way. I can't put any money in here. I got to wait. I've got to wait for this is going to crash. It has to. It's just too high and it's going higher. That's got to be a bad sign. And, we look at that and we say, if you look at the history of pricing in markets, new highs seem to the biggest indicator for more new highs. They come in bunches, and that's the way they come. It's not something to be afraid of, but there are too many people and too many writers that are out there saying, hey, this can't just keep going on. I would be very careful right now after the new high. You have to wait. A year later, you may still be waiting.
Well, that's in fact what's happening because, as you just referred to it, market analysis shows that trends tend to persist. Now, that's in both directions. So if we were in a downtrending market, you should be worried about, will this turn into a bear? I mean, how low is low? You don't know until it's over. But when it's in an uptrending market, then that also tends to persist because there's optimism, and usually there's an underlying fundamental reason why this market is going higher. And that happens to be a number of factors. Good corporate earnings. There's a lot of buybacks. Corporations, and I argued this back in 2020 before the market collapse, that companies are buying back their stock at high prices. Well, guess what? Their prices are higher today. So what looked like a misuse of capital actually turns out to be pretty smart buying, even though it was interrupted with the COVID sell-off. But that also created an opportunity for corporate treasurers to finance cash over a very long period of time at historically low rates. Corporate finance was actually smarter than Mr. Market happened to be at the time. The other reason is we have falling inflation. We have not corporations. We have central bankers around the world cutting interest rates.
Correct.
And that creates liquidity. Now, if you want to talk about why the market goes up, forget about earnings. As long as there's liquidity in the market, the money has to go someplace. And if interest rates are falling, well, that's not real attractive. You want me to tie up my money and when it renews, my CD renews, I'm going to get a lower rate going forward.
Right.
If I'm going to deal with inflation and cost of living and accumulate capital for my retirement or college education for my kids or whatever it happens to be, I need more money 5 and 10 and 15 years from now, not less.
Absolutely.
And that means I need to be in an asset that grows, and liquidity drives asset growth. Now,
And
some assets are long cycle, like real estate.
and it's much tougher to get your money out of. The stock market is not that way. It's as we always say, it's very dynamic, and people get in the cycle of, well, I'm not sure I can get the returns that I need because I'm starting so high. The market's high. If I invest now, it's going to have to go significantly higher. I'm not sure I can make that bet right now. I don't think that's a good. That the odds are in my favor, and so as they're doing, they're just sitting on the cash. The problem is in a time like this, like you said, now with a lot of liquidity, with good earnings, and with all the effects and ancillary effects of AI spreading across the entire economy, there is so much productivity coming out. That too is great for the future of equity growth. And people are waiting for, well, I have to wait for stocks to get a little cheaper. It's just too expensive. Well, what if they don't? What if we are at one of those inflection points where we're going to go higher and we may never go lower than we are right now? You can look back and see that. Look where the market was in the year 2000. Go back and see, well, we're going to go below that? No, probably not. We're probably not going to get back down there again. So things change, markets go up, but the things that don't change are people's attitudes towards, well, this is just too good right now, and I'm not sure it's going to stay good. And so you talk yourself out of the market. New highs, everything is going well, inflation's under control, everything's actually looking pretty good in the economy, and you're going to talk yourself out of the market because, well, I'm not sure it can keep going, instead of saying, well, hey, let's follow the numbers, let's follow the data, let's follow the cash. What's going on right now? Market's doing well, cash is flowing in. That's how these new highs happen. Until something changes, don't fight it. Don't fight the market. Don't pretend that you're smarter than all the other investors combined that are saying, well, it's time for another new all-time high. That means people are seeing something out there. Things are positive. There's no reason to be on the wrong side of that trade until it turns that way. And the market will tell you. There'll be signs. There's not actually like they say, there's not a bell that they ring at the top. You're never going to know for sure, but you're going to know around the time, hey, things have changed, and here are the dangers that are creeping in. Right now, boy, just don't see a lot of that out there.
Part of the reason people are hesitant is because they're looking over their shoulder, the classic rear view mirror syndrome.
Oh yeah, sure.
I remember when I went through the tech bubble collapse and I lost a ton of money, or my spouse did, and we got divorced. I remember when the market it looked like it was good, and then we went to war. Like, I'm thinking of Bush and going back into or what did we do? We go back into Iraq back in 1990. We weren't going back. It was the first time. That was the Kuwait fake out that worked. But right. The market was down 30% in 90 days. Well, those kinds of things create fear. We say, well, at this level, obviously, if the market goes down, I could lose 30% of my money. But that's hindsight bias, instead of taking a look at what is actually going on in today's market, and do the conditions in the market confirm that kind of setup. We can always get a black swan, and there's no way to predict that. But what you do with the black swan is you make adjustments. The issue is, where are we today? Where are trends? Where are profits? Where is liquidity? But let's go back to the who wants to make a millionaire? Who wants to be a millionaire? And of course, everybody wants to be a millionaire unless you're already there. But in the game show, if you didn't know the answer to the question, I mean, you could call 3 people, or you could call a person of your choice. You had some other reference, and you could poll the audience. If you polled the audience, you got a consensus opinion, you were right more often than the other two choices. Either your own intellect, recovery of data that you stored, your specialist that you call, the audience knows more collectively. And that is what is represented in the stock market prices today. Now, that doesn't mean you can't just go buy the S&P 500. That is a simplified decision. Sure. But actually, to get across this hindsight bias threshold, you need to look at some components. And there are 3 super sectors, 11 sectors, and 21 subsectors. So with a little bit of data, it's not expensive, and a little bit of time ranking them, which is not hard to do,
right?
You can identify where Mr. Market is attracting most of the money. That's strength of leadership by sector. And then you have your choice of buying mutual funds or exchange traded funds that focus on those sectors. That gives you diversification. If you want to get a little bit more nuanced, you look at the sectors and find the leaders within each of them. That reduces costs, gives you more concentration on the winners and less drag. Now, what's drag in the market? What drag in the market is broad diversification. And that's a serious problem. It's going to hurt your returns. I was talking.
People are, the market's very concentrated, and you can buy the S&P, like you said, Don, the S&P 500. You may have 10, 15 stocks that are going up, and 485 that are going nowhere. And so that's not a good balance. You're owning a lot of securities that aren't adding anything to your portfolio. And that's one of the reasons people are sitting in cash. They said cash hit, money markets hit $7.7 trillion last week, new record high. $7.7 trillion is sitting in cash. That started, that big buildup started when the Fed started raising rates. And all of a sudden people could get 4 or 5% just sitting in bonds, buying treasuries. And now that that's going away, the move out hasn't started yet, but I believe it will as rates continue to go down and you begin to get that fear of missing out begins to hit, where now I'm only making 2% on my T-bills, and golly, the S&P 500 is up 14%. The spread here is getting kind of painful, and eventually that money's going to reverse. Eventually that money's going to show up back in the market. It's just important, like you said, Don, it's important to track the data, follow where that money is going, and you can do that and stay in the strength in the market as it stays narrow. Don't buy everything. Buy what's in the market that's strong and avoid that weakness, and you have a much better chance of coming out with a profitable trade at any time.
And you may be saying to yourself, but my financial advisors never told me that. I'm supposed to be diversified. I have some bonds and some stocks and some international, and I'm around a bunch of different market components, but not that concentrated. There's research by a professor of finance at Arizona University going all the way back to 1926. He figured out that the growth of the stock market is concentrated in 4% of the stocks between 90 and 100% of the time. That means that 96% of the things you are diversified into are probably not going to be winners. Many of them, if you hold as a buy and hold investor over your lifetime, are going to go bankrupt. They are simply not going to survive the market conditions, the adaptation, particularly in this new industrial revolution of artificial intelligence. We will be surprised in 5 years how many companies have filed bankruptcy because they could not figure out how to adapt to this new universe of applying computer programming to their business. And it's not just some businesses, it's virtually all businesses. If this has been helpful,
use it or lose it. That's the way it's going to be with AI. You have to use it or you're going to lose your company.
If this has been interesting and helpful to you, share it with your friends, your compadres, your co-workers. If you aren't subscribed, there's a link right down here in the bottom somewhere. that says subscribe. Do that. We have more podcasts coming up, and that way you'll get a notice when they go live. Thanks for being with us today. If you want to call and talk to us about your portfolio, send us an email or give us a call on the phone number. We'll be glad. It's a free conversation. We don't need to know how much money you have. We just need to know what is it that you're concerned about with your portfolio. Let's take a look and do a brief analysis on it, tell you whether it's in leadership or if it's a laggard in your portfolio. You should know. If you don't, give us a call. Have a great day.